Maduro has been captured. The United States has stepped in and taken effective administrative control over a country that holds the largest proven oil reserves on the planet. Let's cut to the chase. In this video, I'm breaking down exactly what this means for the market and your portfolio. And the biggest winners of this new world are not the players most retail investors think about. Why this moment is huge. Venezuela has roughly 303 billion barrels of proven oil reserves. That is larger than Saudi Arabia, larger than Canada, larger than Iran. But for years, the world treated those reserves as almost irrelevant because Venezuela's political instability, corruption, collapsed infrastructure, and sanctions made production unpredictable and unreliable. With Maduro removed and U.S. administrators stepping in, all of that uncertainty is suddenly gone. For the first time in decades, global markets believe Venezuelan oil can actually become a stable, predictable part of global supply again. And commodity prices don't move based on what's coming out of the ground today. They move on expectations of what will come out of the ground tomorrow. This single shift rewires those expectations in a massive way. The immediate market reaction. The first and fastest reaction is always in oil futures. When the market sees a giant new source of future supply becoming viable, prices fall sharply. We've already seen a sudden drop that could easily deepen into a 10 to 20% correction. Not because supply changed today, but because the probability of future supply just skyrocketed. Energy stocks like ExxonMobil, Chevron, and ConocoPhillips typically fall right along with oil prices in the short term. This is a reflexive algorithmic response. But historically, these drops reverse quickly when investors realize that U.S. companies will be the ones getting the contracts to rebuild Venezuela's fields, pipelines, refineries, and export operations. Short-term pain becomes long-term opportunity. Emerging markets also react quickly. Venezuela shifting from failed state risk to U.S. stabilized resource hub sends shockwaves through Latin American bonds, currency markets, and equity indexes. Whenever a major regional instability disappears, capital doesn't wait. It floods back in. The rebuild phase, where the real money will be made. The next phase is the multi-year reconstruction of Venezuela's energy sector. The country's oil infrastructure has deteriorated for nearly 2 decades. Production collapsed from over 3 million barrels per day to around 700,000. Wells shut down, refining capacity plunged. Much of the equipment is outdated or unusable. Bringing this system back online requires enormous investments in drilling services, logistics networks, engineering, and modern technology. This is where companies like Schlumberger, Halliburton, and Baker Hughes benefit the most. These are the global leaders in oil field services, and they will be central to restoring Venezuela's upstream and midstream capabilities. Their business is not tied to oil prices as directly as the major drillers. Their revenue comes from contracts, equipment, maintenance, and long-term service agreements. A national rebuild of this scale is exactly the kind of environment where these companies thrive. The U.S. majors also stand to gain significantly. Chevron already had a unique operating license in Venezuela even before this political shift. Under U.S. administration, it becomes a first-in-line partner for production increases, resource assessments, and long-term development projects. Exxon and ConocoPhillips have decades of experience with complex international fields and will be natural participants in the revitalization. What looks like a short-term dip driven by falling oil prices can evolve into a multi-year expansion of reserves, output, and free cash flow. Broader economic and market effects. With the prospect of more global supply, energy inflation eases. A decrease in oil prices directly benefits transportation, logistics, airlines, and manufacturing companies whose margins are heavily tied to fuel costs. That means tailwinds for companies like Delta Airlines, American Airlines, United Airlines, and logistics big names such as FedEx, UPS, and Union Pacific. Lower inflation also strengthens the U.S. dollar as real yields rise and global investors seek safety in American assets during geopolitical transitions. A stronger dollar makes imports cheaper and corporate profits more stable, which flows into higher valuations for U.S. equities. Also remember, Venezuela under Maduro stopped using U.S. dollars for its oils and instead used Chinese yuan. Taking control of Venezuela and removing Maduro will also strengthen the American dollar big time from this perspective. Latin American markets will experience a different kind of uplift. Stability in Venezuela improves risk premiums in neighboring economies. This reduces sovereign credit stress, increases foreign investment flows, and can lift regional ETFs like ILF and EWZ. Venezuela's stabilization also reduces the likelihood of cross-border migration crises, which indirectly benefits Colombia, Brazil, and other economies. Who the winners actually are. So the biggest winners will be the companies involved in reconstructing Venezuela's energy infrastructure. Oilfield services firms are positioned to dominate this phase because they are the ones who physically rebuild wells, drilling systems, and production networks. That means SLB, HAL, BKR. The U.S. majors benefit as partners and operators in long-term development projects. That means XOM, CVX, COP. Transportation companies, airlines, and industrials gain from cheaper fuel and lower inflation. DAL, AAL, UAL, FDX, UPS. What investors should do? You don't want to chase the drop in oil prices. You don't panic sell energy names. And you definitely don't try to guess short-term moves in crude futures. The smart strategy is to understand where the capital will actually flow. It flows into infrastructure, services, and long-term partnerships. It flows into companies that rebuild assets, not just extract them. It flows into sectors that benefit from lower inflation and a more stable energy market. That means accumulate SLB, HL, BKR on weakness hold or scale into XOM, CVX, COP for long-term Venezuela exposure. Consider transport logistics plays like FDX, UPS Watch, ILF, and EWZ for the emerging market rebound. At the end, I want to say this. If you are a long-term investor, this geopolitical shock is not a threat. It is a roadmap. Thanks for watching.